Technical analysis doesn't care about the company's financials or the broader economic conditions. Instead, it focuses on the price movements and patterns in the market. It's more concerned about what's happening in the market right now and how past price action can give us clues about where price might move next. Wagwan. Hey everybody.
Welcome back
to the channel. And in this video, we're going to be diving into the fundamentals of technical analysis, which is a powerful tool that traders use to analyze and predict price movements in the financial markets. So, if you are new to trading or just starting to explore technical analysis, you might be wondering, what exactly is it and how does it help me as a trader? Well, you're in the right place. Let's break it down step by step. First off, let's define what technical analysis actually is. Technical analysis is the study of past market data, primarily price and volume. This data is then studied to forecast future price movements. Instead of focusing on a company's financials or the broader economy, like fundamental analysis does, technical analysis looks directly at price charts and patterns to make predictions about where the market is heading next. So it's directional based decisions rather than value based decisions. So you now might be thinking, why do we care about past price movements? Well, the key idea behind technical analysis is that history repeats itself. By understanding how price has moved in the past, we can use that information to anticipate what might happen next. Interestingly enough, technical analysis dates all the way back to the 17th century in Japan, where traders used charts to study rice prices. But in the modern times, it was popularized in the 20th century by a man named Charles Daw, the founder of the Dow Jones Index. Now, Daw and his partner Edward Jones developed theories about price trends and market behavior, which then laid the foundation for technical analysis as we know it today. Now, let's talk about the difference between technical analysis and another popular method of market analysis, which is fundamental analysis. So, fundamental analysis is all about looking at the intrinsic value of an asset. For example, if you're looking at a stock, you might analyze the company's earnings, revenue, debt, management, and future growth potential. It's all about understanding the health potential of that company. How likely is it to make money, or how likely is it to go bankrupt? You see? On the other hand, technical analysis doesn't care about the company's financials or the broader economic conditions. Instead, it focuses on the price movements and patterns in the market. It's more concerned about what's happening in the market right now and how past price action can give us clues about where price might move next. In essence, fundamental analysis looks at the why behind price moves, while technical analysis looks at the what the market is doing right here and right now. Here's a simple way to think about it. Fundamental analysis is like studying the health of a person, while technical analysis is like studying their heartbeat. Both are important, but they give you different insights. As a trader, many people use both methods to get a well-rounded view of the market. Why technical analysis works? Why does technical analysis actually work? Well, this is where the psychology of the market comes in. The idea behind technical analysis is rooted in market psychology. It's based on the idea that human behavior, which is fear, greed, optimism, and pessimism, leads or tends to follow certain patterns over time. The same psychological reactions to price movements tend to happen repeatedly in the markets, which is why history repeats itself. For instance, when prices fall sharply, panic can set in, causing more selling. This is a pattern we've seen time and time again. Similarly, when prices rise, greed and fear of missing out can drive prices higher, creating a pattern of buying sprees. All of these emotions and reactions are reflected in price charts, and by studying these charts, we can identify patterns that often precede future price movements. Key principles of technical analysis. Now that we have a basic understanding of what technical analysis is and why it works, let's talk about a few key principles that drive the study of technical analysis. 1. Price discounts everything. Okay, the first principle is that price discounts everything. This means that all information, news, earning reports, geopolitical events, and market sentiment is already reflected in the price of an asset. The idea is that the price of an asset already accounts for everything that is happening or will happen in the market. For example, if a company announces a new product, the news will be reflected in the stock price almost instantly. Technical analysis doesn't need to worry about the reasons behind the move. What matters is the price action itself. Principle 2 is that price moves in trends. The second principle is that price moves in trends. What this means is that once a trend is established, whether it's upward, downward, or sideways, it is likely to continue for some time. In other words, the current price movement is more likely to continue than to reverse. This is why trend following strategies are so popular and why they turn to have the highest win rate in technical analysis. By identifying a trend, traders can position themselves to ride that trend until there's evidence it is changing. The trend is your friend. Principle 3 is history repeats itself. Finally, we have the principle that history repeats itself. As I mentioned before, market psychology drives a lot of price action, and human psychology tends to be predictable. The same patterns and behaviors we've seen in the past are likely to happen again in the future. This is why chart patterns like head and shoulders, triangles, double bottoms can be so effective. Traders know that these patterns often precede a big move, and they can use them to predict the next price action. So, to sum it up, technical analysis is the study of price movements and market patterns to forecast future prices. It works because it taps into the psychology of market participants, which is the collective behavior of traders and investors that repeats itself over time. And the 3 key principles we discussed. Price discounts everything, price moves in trends, and history repeats itself. These are the foundations of how technical analysis can be applied to the market. In the next video, we will look at how to read price charts and understand the basic tools that every trader needs to get started. But for now, think of technical analysis as a way to make sense of price action and use historical patterns to your advantage. Thank you for watching, and I'll see you in the next video.